Welcome back to the deep dive. You know how sometimes you're just swimming in market reports and all you want is someone to tell you what's actually happening?
Yeah, just cut through the noise.
Exactly. Well, consider this your data snorkel. Today, we're taking that deep dive into the Southern Arizona rental market. We've got the latest numbers, June 2025, hot off the presses from the multiple listing service of Southern Arizona, MLSSAZ.
Right, the report just dropped, covers data as of July 7th, so it's really fresh.
And our mission, for you listening, is to pull out the key stuff, what's really going on with rents, demand, supply right now, and importantly, how has that changed over time? Okay, let's unpack this.
Sounds good. Yeah, this report is pretty essential for anyone connected to the market here, renting, thinking of moving, investing. It touches everyone.
Totally. So let's start right at the top. The big picture snapshot for June 2025, median lease price, $1,800 a month.
All steady.
Pretty much. What really struck me is it's only up like 0.3% from last June. Tiny change.
Very small adjustment, yeah.
Yeah. And the total number of leases signed, 227. That's actually down a bit, about 3.8% year over year.
Okay, so fewer leases, but the median price is stable.
Right. And the total dollar volume of those rentals follows suit down about 1.4%, landing at $432,560 for the month.
You know, what's fascinating here is that stability. Price and volume holding pretty firm, even with fewer leases signed. It kind of suggests the market's found a certain level, maybe. More mature, perhaps, after all that volatility.
That makes sense. It feels less frantic.
Definitely. And one indicator of that is how long properties are sitting. The median days on market is up to 33 days.
33 days. That's what, 5 days longer than last year?
Exactly, 5 days longer.
So what does that really mean for, renters on the ground or landlords trying to fill vacancies?
Well, for renters, it could mean slightly less pressure. Maybe you don't have to sign the lease the minute you see the place. A little breathing room.
Right.
But for landlords, it signals that pricing strategy is key. You need to be realistic. It's not guaranteed to rent instantly anymore.
Right. And speaking of price, how close are places leasing to their asking price?
That's another interesting piece. On average, they leased for just 0.06% under asking, almost spot on.
So basically at asking price.
Pretty much. And that's actually a bit closer than last year.
Yeah.
So again, it hints at maybe a more balanced negotiation, things settling down a bit.
Okay, that paints a clearer overall picture. But is everyone feeling this stabilization the same way? Or does it depend on what kind of place you're looking for price-wise?
Good question. No, it definitely varies.
Let's zoom in then. Where's the real action? We looked at the breakdown by price range for June, and wow, the $1,500 to $1,999 a month bracket, that was it.
The sweet spot.
Totally. 95 leases in that range alone. That's like nearly half of all of them.
Huge concentration there.
Yeah. And then you compare that to, say, the lower end, $500 and $999 a month, only 15 leases.
Right.
Or the really high end, $3,000 plus, just 8 leases.
And that breakdown tells you so much about where the core demand really lies. If we layer in the days on market and that percent over or under asking for each tier, you see really different competitive landscapes. And this raises an important question. Who actually has the upper hand at each price point?
Okay, lay it on us.
Well, surprisingly, maybe the biggest bidding over asking price. It happened in that top tier, the $3,000 a month plus range. Leases went for almost 2% over the list price there.
Wait, over asking at the high end, but didn't you just say those took longer to rent, the days on market?
I did.
Yeah.
And that's the interesting part. It's not really a contradiction. It points to a smaller, very specific group of renters looking for those luxury places.
Oh, okay.
They might be willing to pay a premium, but because there are fewer of them, it takes longer. The median was 74 days to find that perfect match. So for high-end landlords, it's more of a marathon, not a sprint.
Gotcha. So what about that big middle range, the $1,500, $1,999 one?
That one. It's moving fast, median 31 days on market, and leasing almost exactly at asking price, just 0.01% over. High demand, very efficient.
So that's where the volume and speed are.
Exactly. And then in some other ranges, like the $1,000, $1,499 bracket, or even $2,500, $2,999, they actually leased for under asking price on average.
Meaning renters might have a bit more wiggle room there.
Potentially, yeah. It suggests more negotiation power for renters in those specific segments. It's really a patchwork, different dynamics everywhere.
A patchwork of micro markets. I like that. I mean, let's flip the coin then. Talk about the supply side. What's coming onto the market?
Right, inventory.
In June, we saw 384 new rental listings hit the MLS. That's up just a tiny bit from last year, only 8 more listings.
So new supply is pretty stable, too.
Seems like it. But interestingly, the number of new pendings places going under contract that was down slightly. 87 new pendings, which is 7 fewer than last June.
Okay, so slightly more new listings, slightly fewer getting snapped up immediately. What does that do to the overall active count?
Good question. Right now, total active listings stand at 846.
846 available units.
And that brings us to the months of supply figure. It's currently at 3.73 months.
Okay, 3.73 months of supply. Let's break that down. That basically means if no new rentals came on the market at the current pace of leasing, it would take just under 4 months to rent out everything that's currently available.
So what does that number 3.73 tell us about the market balance? Is it favoring landlords or tenants?
Well, historically, a market considered truly balanced is often around, say, 5 to 6 months of supply. So at 3.73, we're still leaning a bit towards the landlord side.
Okay, not a renter's paradise yet.
Definitely not. But it's also not the super intense, got to bid way over asking landlords market we saw maybe a couple of years back. It's moving towards balance.
Oh, that's helpful context. And what kinds of places are actually making up this inventory and getting leads?
Yeah, good point. Looking at June's leases, single-family homes were the big winner. 501 leases.
Wow, dominates.
It really does. Followed by condos at 191 leases, townhouses at 137, and then just a handful, 12, of casitas or guest houses.
Interesting. What about the age of these places? Are people renting brand new builds or older homes?
Mostly middle-aged stock, actually. The most active age brackets for leased properties were those built between 2000 and 2009 that saw 60 leases. And then 1990 to 1999, that had 34 leases.
So 90s and 2000s builds are popular.
Very much so. The median year built for everything leased in June was 1995, and the average size was about 1,578 square feet.
All right.
So it tells us the demand is strong for, decent-sized family homes, maybe 3-bedroom, 2-bath type places built in the last, say, 20, 30 years. Not necessarily brand spanking new.
Right, the established neighborhoods. Okay, so we've got the June snapshot. We've looked at supply and demand. Here's where it gets really interesting. Let's pull the lens back. How do these June numbers fit into the bigger picture, the longer-term trend?
Yeah, the historical context is crucial.
Let's start with the year-to-date numbers for 2025. So this is everything from January 1st up to July 7th. The median lease price for the year so far, $1,775.
Okay, $1,775.
Which is actually down 1.4% compared to the same period last year.
Huh. So June was up slightly year over year, but the whole year so far is down slightly.
Exactly. Suggests maybe some month-to-month bumps, but the overall trend this year has been a slight cooling or stabilization after maybe dipping earlier in the year.
Makes sense. What about the number of leases?
Year-to-date, 1,260 leases signed, also down a bit, 3.4% from last year's YTD count.
Okay.
But here's a contrast. New listings are up. Year-to-date, we've seen 1,992 new rentals hit the market, which is a pretty healthy 4.5% increase over last year.
More listings, slightly fewer leases.
Yeah, and that feeds into the days on market. Year-to-date, the median time is 34 days. That's up 6 days compared to last year's YTD median.
So again, that year-to-date data really echoes what we saw in June, just maybe slightly magnified. It reinforces that shift towards a more balanced market. Slower pace, more inventory building up relative to immediate demand.
Right.
And if you compare this to, like, the really long view, the change is just dramatic.
How so?
Think about a standard 3-bedroom rental.
Yeah.
Go back to 2010. The median rent then was about $1,025 a month.
Wow. Okay.
Fast forward to now, 2025 year-to-date.
Yeah.
That same median 3-bedroom, $7,795.
That's a huge increase, nearly $800 more per month.
It's massive. And you see similar leaks for other sizes. 2 bedrooms went from roughly $795 to $1,445. 4 bedrooms jumped from $1,200 to over $2,100.
Incredible. What about price per square foot? Did that follow the same crazy trajectory?
It did, though it peaked a bit earlier. The dollar per square foot high point was actually back in 2022 at $1.70 per square foot on average.
Okay.
It's come down since then. For 2025 year-to-date, it's sitting at $1.28 per square foot.
So prices exploded over the decade, peaked a couple years ago, and now they're adjusting downwards a bit from that peak, even though they're still way higher than 2010.
Exactly. It shows that while affordability has definitely taken a hit long-term, the market is currently finding a slightly lower price level than the absolute frenzy of 2022.
And overall activity, like the total number of leases signed each year.
If you look at the chart going back to 2010, you see peak years for the sheer number of leases around 2013, 2014. Same for the total dollar volume, peaked around 2013.
So we're not actually leasing more properties now than we were a decade ago?
Not in terms of raw numbers, no. The 2025 year-to-date figures are definitely below those historical peak years, which again signals maybe a moderation in overall rental activity volume compared to those earlier highs.
It really paints a picture of transformation, doesn't it? But also, this current moment feels like a recalibration.
That's a good word for it. Recalibration.
Okay, now let's get really specific. Hyper-local. Because you said it before, Southern Arizona isn't just one market.
Absolutely not. Location matters hugely.
We pulled some regional and zip code comparisons for June 2025 versus June 2024, and some of these numbers are just wild.
Oh yeah. Like what?
Okay, check this out. The Northeast region, number of leases, up 300%.
300%.
Yes, and the total rental volume in that region, up 373.3%.
Wow. What's driving that? New construction flooding the rental market there.
Could be. What's odd, though, is the median lease price in the Northeast actually went down slightly by $155 to $1,995.
Huh. So tons more activity. But prices softening just a hair. That is fascinating. Maybe larger, slightly cheaper units came online,
Yeah.
or just intense competition among new listings.
It definitely warrants a closer look for anyone interested in that area. Then you've got, say, the upper Southeast region, also strong growth leases, up almost 28%, volume up nearly 40%.
Okay.
And there, the median price went up by $205 to $2,100. And things rented faster, too. Median days on market dropped by 11 days, down to just 17.
So Upper Southeast is hot, growing activity, rising prices, faster rentals.
Seems like it. But then contrast that with the West region. Leases there were down 50% year over year, volume down almost 47%.
Whoa, polar opposite. See, this is what I mean about micromarkets. Huge swings depending on where you look.
It's incredibly localized. And the zip code data makes it even starker. Remember that Northeast region surge?
Yeah?
Zip code 85641 mirrors it almost perfectly. Leases up 300%, volume up over 304%.
Okay, so 85641 is likely a big part of that Northeast story.
Must be. And get this, the median days on market in 85641, it plummeted, down 51 days. Properties there entered in a median of just 27 days in June.
Incredible. So that specific zip code is seeing intense demand, rapid turnover.
Yeah.
Something is definitely drawing renters there right now.
Absolutely. And you see other notable shifts too, like 85705 saw leases jump over 60%. Meanwhile, 80711 saw its rental volume drop by half.
What's fascinating here is just how different the story can be from one zip code to the next, even within the same metro area.
Right.
And these aren't just abstract numbers. These shifts directly impact real decisions. If you're a renter, maybe 85641 is competitive, but maybe 85711 has deals. If you're an investor, where are the signs of emerging demand versus potential saturation?
It really brings it down to the street level.
It has to. Understanding these granular shifts is absolutely critical for navigating the market effectively, whether you're renting, buying an investment property, or deciding where to list your own rental.
Okay, so let's try and wrap this up for you, our listeners. What's the big takeaway from this June 2025 deep dive into Southern Arizona rentals? Well, the headline number, that median price, shows remarkable stability year over year, $1,800, holding firm.
Pretty stable on the surface.
Right. But don't let that fool you. Underneath that calm surface, there's a lot going on. We're seeing shifts in how long things take to rent, slight changes in volume, and really different dynamics depending on the price point.
And crucially, those dramatic differences from one neighborhood or zip code to the next.
Exactly. The Northeast and 85641 exploding, the West Side cooling off. It's a real patchwork. Understanding these nuances, these specific trends, that's really the key to making smart moves in this market right now.
So what does this all mean for you, for your own rental decisions, or even just understanding the pulse of the local economy? Here's something to maybe mull over. We've seen this incredible historical run-up in rental prices over the last 10, 15 years. Now we see these really stark regional shifts happening. While the overall median price for Southern Arizona seems to have found a stable plateau, at least for June, what does that sustained stability combined with the localized volatility truly suggest about the current balance between that long-term growth pressure and more immediate market forces? And maybe more importantly, how might that delicate balance shift or evolve in the months ahead?